Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Let's take a look at how things are shaping up so far this year in the stock market. And looking at Wall Street, we have stocks pretty much wiping out most of the gains so far this year as fears rise about where rates are going. And this as we see rate fears kick in that perhaps there'll be fewer than expected rate cuts. So what's in store for the rest of the year? Let's check in now with Mahesh Sethuraman. He is the Singapore CEO for SAXO. Good morning, Mahesh. How are you doing today? Happy New Year.
Thank you so much. Happy New Year to you too. I'm doing fine. It's been an interesting start to the year.
Interesting start indeed. Let's talk about what's happening in the markets, Mahesh. What have been your takeaways so far? Have they been pretty much in line with expectations?
I would say so because, pre-election, the market expected disinflation to continue. We expected central banks around the world to sort of accelerate the rate cut path. But post the election of Trump, market has had to reprice the expectations around inflation, the expectations around rate cuts. And therefore, the sort of confusion that you see in the market, the lack of conviction is understandable. To be honest, I expect that to play out over the next couple of quarters.
All right, let's unpack what's happening here. Do you think the fears, the concerns are justified?
I think so because with Trump, you always expect the tariff to become a problem. You also expect Trump to do some sort of tax cuts, at the very least extend the tax cuts that are due to expire, the one that he did in 2018. That are due to expire, he's likely going to sort of extend that. And also, the tariffs, you do not know how he's going to play, right? I mean, last time, the sort of what he did in 2018 is not a roadmap for us. It's going to be different this time. And also, U.S. fiscal balance is in a different place right now. There's not too much scope for him to cut rates. There's not too much scope for him to spend without cutting revenues. So he's walking a pretty tight rope, and the market is figuring out how he's going to walk that rope.
Yeah, definitely a lot to watch out for, including how he approaches China as well. So that's another segment we are going to be touching on. Let's take a look at what your clients are doing. What are you seeing when it comes to market positioning?
Most of the clients, so one thing that you've seen over the last 6 months in the second half of 2024 is a lot more clients are diversifying, but they're diversifying mostly via ETFs. So you do see clients getting a lot more broad-based exposure, a lot more are sort of tracking indices, which I think is a good trend in a market like this. But predominantly, our clients are still heavily invested in tech names, U.S. tech names. But we've also seen quite a bit of interest in Hong Kong tech names, which is kind of, we had a lot of momentum in the second half of last year, but that's also waning a little bit. So our client positioning captures the broader uncertainty in the market where they expect the global growth to continue. They expect U.S. exceptionalism to continue, but they're not sure if it's going to continue at the same pace as it's been for the last 3 years.
Okay, so tech still in favor to some extent, but you are seeing some diversification of sorts with that approach towards ETFs. What are they cutting exposure from? What are they selling?
I mean, we did have a lot of positioning going into Hong Kong, both index and China stocks last year. That is definitely getting pruned at the beginning of the year, or probably even towards the end of the year, last month, December and January so far. We've seen pruning of positioning in China. We've also seen pruning of positioning in FANG stocks. It's still the most popular, but we've seen some amount of pruning of positions. They've either started booking profits or reducing the risk to figure out what's going on. We've seen an increased positioning in bonds, which was reducing in the third quarter, last quarter and early on positioning into bonds, which is a bit surprising. And there's also been a bit of an unwinding on gold as well.
Unwinding of gold, of course, we had a banner year on that front. Where do you see things going for gold? Because we have quite a similar backdrop when it comes to inflation as well as where the economy is going.
That's true, but gold is also not just a hedge against inflation, it's also a hedge against geopolitics and all the escalation that is expected to happen. So, I mean, even though we have seen some amount of unwinding of gold, we still see positioning in gold to be reasonably heavy as compared to, let's say, the baseline of the last 3 years. And we expect gold to remain supported. In fact, our base case is that it's likely to test $3,000 this year.
All right. You mentioned China earlier. Where do you see China when it comes to the stock market, at least?
I mean, there are not too many sort of tailwinds for China at the moment. The geopolitics is still uncertain. The policy measures are still not sufficient to address the consumption problems. That is from a macroeconomic perspective. The challenges are there. The challenges will likely continue for the rest of the year. Even though we'll make some progress, I don't think we'll make sufficient progress to gain critical mass for China to get out of this problem. Having said that, from a stock market perspective, from an investor's perspective, it's available at a steep discount. And it is still a massive economy. It's still growing at close to 5%. And for an economy of that size to grow close to 5% is immense. Purely from a valuation perspective, it's still attractive, but it's only for patient investors who can benefit from such depressed valuation, which means, you could take a few years to get the upside, but I cannot deny the fact that the valuation is attractive.
All right. One to take note depending on your investment horizon. All right. Before we wrap things up, Mahesh, final takeaways. What would be your advice to clients as they take on 2025?
It's going to be a year of dispersion. It's going to be a good year for active fund managers. But for most people for whom investment is just a part-time job and they have a full-time job, there's never been a better time to diversify. So do not put all your eggs in one basket. Do not put all your eggs in one industry. Diversify across companies, diversify across industries. Have a good diversified portfolio. You're not going to make the most money by doing that, but you're going to have a healthy rate of return and you're going to sleep peacefully. So there's never been a better time to diversify. I would strongly urge all retail investors to stay diversified.
All right, steady as it goes. We've been in conversation with Mahesh Sethuraman. He is the Singapore CEO for SAXO. Mahesh, thank you for your time and insights today.
Thank you so much.
Great chatting with you. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.